Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the cash flow memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Let's start on Exhibit C. Since last Wednesday, we had the military activity in Iran. This estimate of crude supply in 26, obviously, if this is settled in another week or two, this crude supply schedule on Exhibit C will change. So far, based on all the press reports, including the oil press, there hasn't been too much damage in physical facilities. But I think that Iran will not do the same amount of oil they did last year, which is what this table calls for. Even though we get an uptick in oil pricing, I still think that the U.S. will produce less oil in 26 than they did in 25, because whatever this lift is will go away fairly promptly once missiles and drones stop. Russia's forecasted here to be about level with last year. Iraq up a little, UAE up a little. The interesting thing about this table is that oil production for the full year is about flat with last year. The U.S. down, Saudi Arabia about 400, Russia off a little. And that's what's required, because if you go down to the consumption table, the consumption is only up by about 400,000 barrels. I mention this most Wednesdays, but the oil industry, worldwide oil industry, was used to dealing with growth of around 1.5 million barrels a day of additional demand per year. But with China flattening out and the rest of the developed world, US and Europe and Japan, also flat, because they've been flat for years, for a decade or more. China was, with its being the second largest economy in the world, was providing half of the growth of demand. And so demand growth now is back 700,000 barrels, not 1.5 million. And that means that it'll just take longer for supply to adjust. These prices on the bottom of Exhibit B are from last Thursday, so they don't show the impact when we put down the prices for this Thursday. I'm pretty sure that near month will be in the 70s, probably mid-70s for WTI. But the 27 price at 61 last Thursday will probably be only up $2 or $3. So a huge amount of backwardation. And the gas price is not necessarily going to benefit from all this. One of the principal exporters of LNG is Qatar, and all the LNG ships have to pass through the Persian Gulf and through the Straits of Hormuz. And so Qatar is announced Monday that they were going to shut in their production and in effect shut down their LNG trains. That has really bounced prices for gas and electricity in Europe. And I don't think that's going to translate back to the US, because our LNG capacity is basically flat out. And the problems with natural gas in the period since, say, last fall is the price keeps going down. The 27 price at 370, the strip used to be 4.25. The 26 price at 350, the strip used to be $4. The problem with some optimism in oil and having WTI, at least near month at 75, is there'll be somewhat less curtailment of rigs and frac crews and whatnot. And that's going to mean more gas. The growth in gas supply is in the second set of numbers here. It's 15 Bs a day. 10 of it comes from the Permian. That's all associated gas. So this, hopefully the gas price holds in that 350 range and doesn't go back down. You can see here in 24 prices, gas average 240. We don't want to see that kind of price again. Hopefully it'll hold in the 350 range. U.S. government revenues and expenses, the tariff revenues, according to the Treasury Secretary, will be pretty much what they were planned despite the Supreme Court decision. They're using other legislative capability to maintain tariffs. I think the federal government, the estimates I've seen are that have to refund about $200 billion, but I don't think they're going to do that very quickly. So I think this revenue for estimated 26 of $500 billion or $500 billion for excise taxes and whatnot is probably a good number. That's up from, say, by 2 times from 24, which was 240 billion, but I think that's a good number. The key to getting this on a downward trajectory where the deficit declines rather than increases and the debt held by public is flatlines around 100% is to keep that spending coming down or at least flatlining. And here spending's in the fiscal year we're in is $7 trillion compared to just over $7 trillion in 25. And what happens is inflation and real GNP growth brings individual income tax and payroll tax and some help from corporate income tax. So, you know, the projection here is we go from $1.9 trillion of deficit in the last fiscal year to $1.5 trillion this year. And hopefully when we start to put down numbers for 27, that $1.5 trillion will work its way down to 1.2 or 1.3. That's probably better than most other economies are doing. It's hard to tell in China because they do a lot of their borrowing at the province level. In Europe, committing to spend more money on defense, and they still have big social programs. So presumably they're going to be incurring bigger deficits. Japan, which we all think of as being very conservative, have run these budget deficits. So the amount of government debt in Japan is 200% of their GNP. We're modified by 100%. But the Japanese secret is they kept their interest rates very low. Their central bank is definitely not independent of their elected government, and but that is changing a bit. The long-term Japanese treasuries are now 2%, where they used to be like 0.5%. But they finance that deficit with internal savings, so they're not dependent on people deciding they no longer want to hold Japanese government debt. They still, I think, it is a question mark for that economy. The point I want to make is that we're going to look like we're performing very well to have our deficit be going down because Japan is high. Germany and the rest of Europe will be increasing because of trying to raise their defense spending. And China, I think, is running deficits if you had a true picture of the provincial debt. So people who say the dollar's weak, going to get weaker, that's a reason for gold price being so high. I think as the year goes on, it'll become more clear that the trend in U.S. fiscal spending has improved. We haven't done page 1 in a while, and we want to reserve time for Jason and healthcare. But news on page 1 over the past week or so is that, before my for Jason comment, these stocks, which constitute 40% of the S&P index, including a couple of others, Nvidia and Meta, are steady as a rock. They're down a little bit, but nothing too significant. So one of the things about our economy is no longer, I think our deficit will be improving, but the stock market value, which shows volatility when we get into one of these things like Iran, and people say, oh, the problem is there are 7 stocks, and Mag 7 stocks are 40% of the index. These stocks are actually pretty solid. They don't move a whole heck of a lot. So as an investor, either in the index or in these stocks, you may have some number of quarters where you don't have much lift, but at least based on the performance of these companies and their equities, they don't seem very volatile to the downside to me. With that, Mike, Jason, is that a total misread, do you think, or how does it look to the two of you?
No, yeah, I think these companies, because they're growing into some of the valuations that were set because of growth, much of it related to AI and deployment of new data centers in the case of some of these. Apple recently launching some new products. Google obviously doing extraordinarily well with their AI systems. They're growing into the valuation. Some of them are relatively expensive on a multiple of free cash flow, but they are growing into them. Nvidia also just reported earnings. That's another one that, even though it's down after earnings, the growth rate of revenue is inflecting up, which is interesting. That's not a normal response. So this all has, I think, a positive effect on any concerns that people might have over concentration in the index.
I mean, the overvaluation statistically is in Tesla, but there's a great deal of confidence that either humanoid robots or robotaxis justify having Tesla trade for $1.3 trillion rather than with $7 billion of free cash flow, rather than trade for 300 or 400 billion. And that seems like a big stretch, but that overvaluation for the upside in those two areas is pretty well, it doesn't vary a whole heck of a lot. Mason believes that if you give us enough time, robotaxis, we might have on the road, we might have half robotaxis. If you do that, if something like that is feasible, granted, some of it will be Waymo's, which is partly owned by Alphabet, but if something like that happens, you won't even need humanoid robots. That prospect is probably worse, the overvaluation in Tesla stock. That's not an overstatement, is it, Jason?
No, I just don't know when that occurs, but I'm confident that someday we'll be there. Tesla is interesting because they're explicitly saying they're no longer a car company, and they have the first robo-taxis coming off the line, and I don't think it made big news, but they've canceled production of the Model S and the Model X. So they're no longer building those cars. They're only building the cheaper models with full self-driving and putting a lot of prioritization from those that exist in manufacturing equipment. Now they're going to put that towards building robo-taxis.
Humanoid robots.
Oh, they're going to do that.
Yeah.
Yeah. So they're pushing extremely hard into this, and Elon always overestimates his timelines, but he certainly thinks it's more near term.
Yeah, I think the thing that's most people haven't wrapped their heads around, for good reason, because they haven't shown us what the next generation of the robots are like, is that because them shutting down Model S and Model X production is so that they can do robots. And they say that they think they're going to be able to do 1 million robots a year out of the Fremont factory. It's an interesting signal when we have not seen Gen 3 of these humanoid robots. We were obviously quite impressed with what Boston Dynamics put out at CES earlier this year. So we will find out in relatively short order what Tesla's been working on.
Right. Page 2, there's been a huge amount of unease about Salesforce, ServiceNow, and Snowflake and other software companies. But once again, those shares are down, but they've stabilized. I think that the thinking is that you may be using the Claude app from Anthropic, where You're not, that's not gonna, that's not gonna replace your contract or your service relationship with people like Salesforce and ServiceNow, and that Snowflake somehow has a role here to try to take away. Jason, we haven't talked about this in a while, but Snowflake enables you to have a more competent IT department than would otherwise be the case, because the Snowflake product can substantially enhance the capability of IT departments. Is that kind of in the right direction, Jason, or how do you characterize Snowflake's role in the world?
Yeah, no, I would say it also enhances the business intelligence team as well. So they're able to use Snowflake to have all of the unstructured data that you generate as a business go into a platform that allows you to search it with SQL to do more structured things. And now with AI, now it's available in a structured manner to the language models that you're using.
I think the thing to point out here is the big change in software over the last couple of years. We had LLMs. Really, everybody woke up to that with the launch of ChatGPT 3, I guess it was, that kind of caught everybody's surprise in 2022. But then the advent of the reasoning model, which you'll remember that was just over a year ago. It's amazing how fast things move. But reasoning increased token usage exponentially. And most recently, we are shifting into a world of agents, which is having a similar increase in the number of tokens consumed. Now, one of the things that we like to say is that when artificial intelligence works, it's really just software. And what you're seeing and what the panic in all these software stocks going down is concerned that AI is just going to essentially eat software. And that will be the case for some stuff. One thing you need to be aware of, though, is that these companies on page 2, many of them have some of the better software developers in the world, page 1, page 2, and part of page 3. So who is best positioned to capitalize on this technology? It's really on page 2, it's up to Salesforce, ServiceNow, Snowflake, Oracle, in some cases Broadcom, to capitalize on it.
One way I'm thinking about it too is these AI agents have memory like a goldfish. It's very short. And it's, in the case of the Claude bot and what everyone's been playing with, it's just a set of files that you have locally. Where these companies are the memory for your AI. They're storing all the historical data that you've generated, and your AI can then go back and search that. So in the near term, I don't think these kind of systems go away. Your AI needs a memory somewhere. All the data has to be stored somewhere to make it available in the future.
Yeah, which is why we like Snowflake, because the data play there is very parallel to the growth of autonomous agentic agents.
Before we get to healthcare, we got to talk Nvidia. It has great results. The stock went down. Not a great deal, really. But look at what they've been able to do. As of last Thursday, their equity value is $4.3 trillion. Just scan across page 1. Apple, which has had a significant recovery, 3.9, Amazon 2.2, Alphabet, which, had it was last year. I think some people had it pegged as $150 stock, and it wound up the year at 300. But Alphabet at 3.7, Microsoft at 2.9. It's amazing. Nvidia, which some number of years ago was just making game cards, has just completely run circles around everyone else. Look at their sales at $200 billion against AMD at 33 and Intel at 53. Look at their free cash flow. This is really unusual. At $200 billion in revenues, their free cash flow is about 50%. That's after taxes, after capex. It's really extraordinary. And Google has their chip. Amazon says they're going to be more, they're going to use more of their internal chips. AMD has a chip. Intel has somehow got the equipment, but can't seem to make the chips. But Nvidia just goes on from triumph to triumph. But still, and at 4.5 trillion against 100 billion of free cash flow, not it's 40 times. It's not impossible number. Jason, where's the chink in the Nvidia armor, do you think?
It's a good question. They really are the modern Intel from the Wintel days of AI data centers. It's hard to say.
I have a view on this. I think the bottleneck is ultimately permitting. If, and there already is, there's a public pushback on data center development. If we're expecting that we're going to build more data centers every year the next couple of years, this is going to become the number one choke point. I think we've established fairly clearly that the energy issue is something that the energy industry is fairly good at solving. And that doesn't seem to be a clear bottleneck. And then if you listen to Elon Musk, he will tell you that once you get launch costs per pound down to a certain level, it's easier to deploy data centers in space than it is to do it on land. And the reason is more to do with the regulatory side of things than it is with anything else.
I guess I'd say the risk I see would be software related, that these models can be condensed enough, excuse me, to at some point run on phones and effectively. And at that point, you may not need all the data center capacity for if the AI is a distributed network among iPhones and Samsung phones.
Sounds with Jason having a bit of congestion. Mike, it sounds like you're going to carry most of the healthcare with Jason straightening you out when you misstate something or omit something. I know when I talked to Mike this morning, he was focusing on the Harrow results, but how, in just a sentence or two, how did Harrow come through this publishing their results and making predictions for the coming years?
If you check the stock, you would think that they had a horrible result. The stock sold off 20-some%. But they did report record Q4 and full year 25 results. The main reason it sold off is on guidance. Their 2026 guidance was very conservative. And in reading the CEO's letter and listening to the earnings call, they made it very clear that they are deliberately being cautious with guidance. And when you're doing concentrated equity investing, one of the main things that you want to underwrite are the management. And because management will say, most of the time will say whatever they possibly can say to keep the stock price going up. We feel that these are, aside from the fact that the CEO is the founder and holds a large chunk of stock, we feel fairly good about his level of integrity. Historically, they have given aggressive estimates. And this past year, they actually had to revise down their revenue estimate by a few $1 million. They got hit with a shareholder lawsuit last year, and that created a very good buying opportunity, which we participate in. And I think this year, they came into the year with a very clear objective to not have that happen again. By issuing very conservative guidance, they've now spooked the market. All in all, we're very happy with the progress of all the products that are on the ground and the new product launches that they have coming that were due to deals that they secured this past year. Actually, we really like the position they're in, and we're not disappointed by having a lower price.
Yeah, I would add that their main product is Vivi. It's an eye drop for dry eye disease, and they're giving the weak guidance, but at the same time talking about how strong of tailwinds they have in that business. So on January 1st of this year, they got primary status as the dry eye drop for CVS's PBM. The tailwind there that they're already starting to see is an uptick in prescriptions and should be higher, should also result in higher average sale price through that channel. Since direct sales were $59 for the company and they were trying to underprice the market. They see that opportunity and they're doubling their sales force for that product It did about 90 million in revenue this year, and then the forecast for it is generally somewhere north of 100. So very little growth is baked into their guide, and we think that's extremely conservative.
Jason, what about other healthcare news this week?
Other news, the FDA approved a Boehringer drug called Hernexios, which used a national priority review voucher. So the approval took a total of 44 days from submission. This is the second use of this new permit that the FDA rolled out just last year. And this treatment, it's going to be a first-line treatment for non-small cell lung cancer. The drug had previously been approved in for another indication. So maybe that's the model for these extremely accelerated approvals. It already went through the process looking for the typical process that looked at the safety data. And then in this case, the data for efficacy was compelling enough to have the approval in essentially a month. So that's some good news.
The other one I'd add is the FDA issued some guidance on a one trial default. Do you want to elaborate on that a little bit?
Yeah, the default is that you'll run 2 phase 3 clinical studies, and they're rolling that back to maybe that the default should be 1 phase 3 study and then a prolonged follow-up period. They call them phase 4 studies, but it's in market and you're looking at the safety efficacy data as you're actually treating real-world patients. The implication there is it's going to obviously save a ton of costs. The most expensive study is your phase 3 study. Some companies don't have the capacity to run 2 phase 3 studies in parallel, the smaller biotechs, so they'll run them in sequence. In those cases, this will accelerate the time to market, potentially by years. So lower cost to bring the drug to market, and potentially if the timeline's lower, then you have a longer runway when you're on patent, a longer time to realize your costs, and essentially makes the drugs all more valuable. You'll have a higher ROI on your research expense.
I think for the average trial, they said it was about $150 million in expense.
Where Nvidia, of all the tech companies, whose performance execution so far is just outdistanced everyone, even the Alphabet comeback last year, which healthcare stock should get that kind of recognition? Jason, is it Lilly or?
I would say none of them, but they're just not as good businesses. It is really hard to have a great business in healthcare, is my opinion. But Jason, tell me I'm wrong.
If we drew the analogy of Nvidia and Intel ran its course. They missed the next phase of computing. It's possible that Nvidia does the same, makes the same mistake. Drugs have a patent life, and the big pharma fills their pipelines with acquiring smaller biotechs for the most part. I'd say the company that does it best is Vertex.
Well, that's what I was just going to say. And the reason that Vertex does a better job of it is their in-house product development is very good. All of the big drug companies develop a lot in-house, but I think if you were to look at their return on R&D, Vertex's is in another league.
Yeah.
Interesting. Calling out Vertex for not quite Nvidia, but head and shoulders better at coming up with their own development of drugs, not having to go out and do M&A to meet patent cliffs. That's pretty high praise, I guess. We'll be here 7 days from now, and there'll be more news on Iran. And I think the only thing in closing, I think Mike and Jason would support, is that the capital markets of the United States are more than able to accommodate macro events like closing the Straits of Hormuz and having this uncertainty on future oil supplies. And it's really a tribute to the quality of the businesses that underlie the capital markets in the United States. We should, of course, be very proud of how our military performs, but I think we should also be very proud of the way the capital markets perform, and the underlying basis for that is basically the private businesses that have been built up in the U.S. With that, everyone be well and stay healthy, and we'll be here exactly 7 days from now. Thanks very much for listening. Take care.
The views expressed on this podcast are the hosts alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.